Three major models appear frequently in U.S. fractional ownership: direct property share through a legal entity, private fund structure where investors own shares of a portfolio, crowdfunding equity in early-stage companies. Each model has different liquidity conditions. Liquidity means how easily you can exit. Some real estate structures restrict resale for several years. Startup equity may remain illiquid until a major event occurs. Investors must review offering documents carefully. Housing affordability challenges in large metro areas have pushed people to look for alternative exposure. Stock market volatility has made some investors search for tangible asset participation. Younger professionals prefer digital access and lower minimums. Fractional ownership responds to these pressures. According to industry reports, online real estate investment platforms in the U.S. have attracted billions in cumulative capital over the last decade. Participation continues expanding, especially among professionals under 45. Scale alone does not make something suitable for everyone. Before participating, a serious investor evaluates 4 factors: asset quality, management team, fee structure, time horizon. Asset quality determines long-term sustainability. A property in a stable rental market with job growth presents a different profile than a speculative development project. A startup with clear revenue is different from one operating purely on projections. Management matters because investors are not directly operating the asset. Operational discipline affects results. Review leadership background, execution track record, and transparency. Fee structure impacts net outcome. Platforms charge management and administrative fees. Those fees reduce distributable income. Understanding the full cost structure protects capital. Time horizon is critical. Fractional ownership often requires patience. Selling your share may not be immediate. Participation must align with personal financial planning. Diversification plays a role. Instead of allocating all capital into one full property, some investors spread smaller allocations across multiple fractional opportunities: one residential rental in the Southeast, one industrial property in the Midwest, one farmland lease. This reduces concentration exposure. Diversification does not eliminate risk. Market cycles influence income stability and asset valuation. Economic slowdowns can affect occupancy, consumer spending, and startup funding environments. Regulation remains central. In the United States, securities offerings must comply with federal rules. Registered platforms provide disclosures. Investors should verify platform registration and offering details through official filings. Transparency is improving. Responsibility remains with the investor. The deeper question remains: is fractional ownership building wealth, or is it simply repackaging traditional investment structures into digital form? The answer depends on discipline. If treated as a structured ownership strategy aligned with long-term goals, it can serve as a useful tool. If treated as a trend without analysis, outcomes may disappoint. Ownership remains powerful in the U.S. economy. The structure has evolved. Access has expanded. Entry thresholds have lowered. The next section breaks down real-life U.S. scenarios: who benefits most from this model, common mistakes new investors make, and how to decide whether fractional ownership fits your financial path. Access has changed. Responsibility has not. Fractional ownership attracts attention because it lowers entry barriers, yet its true impact depends on how it fits into an individual's financial structure. In the United States, income levels, cost of living, and career paths vary widely. A professional in Dallas earning a stable salary faces different conditions than a freelance designer in Los Angeles, or a nurse in Ohio managing family expenses. Suitability depends on cash flow stability, emergency reserves, and long-term objectives. Realistic American scenarios clarify this. A dual-income household in Charlotte with stable employment and consistent monthly surplus after expenses wants exposure to income-producing real estate without property management responsibilities. Fractional real estate participation allows allocation of surplus capital into diversified rental properties across different states. Quarterly updates and income distributions arrive without daily operational involvement. A young engineer in Seattle working in the technology sector receives salary and performance bonuses. Career mobility is high. Relocation within 3 years is possible. Purchasing and managing physical property locally may not align with lifestyle flexibility. Fractional ownership allows geographic diversification without anchoring to one market. A small business owner in Ohio experiences seasonal cash flow fluctuations. Liquidity matters. Entering long lockup structures may create pressure during slower cycles. Limited liquidity becomes a significant factor. Multi-year commitments may not align with variable income. Suitability depends on financial stability and planning discipline. Lower capital requirement remains the most visible advantage. Traditional property acquisition in strong metro areas often demands significant upfront cash. Fractional models allow smaller participation levels. Operational convenience adds efficiency. Professional management teams handle leasing, maintenance coordination, and reporting. Investors review updates rather than respond to tenant issues. Geographic diversification becomes practical. Capital can be distributed across multiple regions with different economic drivers. Logistics facilities in Tennessee respond to distribution demand. Residential rentals in Florida respond to population growth. Structural realities must be understood clearly. Control is limited. Fractional investors usually do not influence daily operational decisions. Strategic control remains with the management entity. Liquidity restrictions are common. Many offerings specify holding periods. Secondary markets may exist, yet pricing and demand can vary. Valuation transparency differs by asset type. Publicly traded assets have continuous pricing visibility. Private real estate or startup shares rely on periodic reporting and appraisal methods. Behavioral discipline matters. Digital dashboards display portfolio summaries. Income deposits appear automatically. Convenience should not reduce analytical rigor. Performance reports, occupancy data, and management commentary require regular review. Cash flow consistency varies by asset class. Rental properties generate income based on occupancy and rental rates. Economic shifts influence both. Industrial properties tied to logistics may experience demand growth during certain cycles. Office properties in urban cores have adjusted due to remote work trends. Sector exposure influences stability. Private company equity presents greater variability. Revenue growth, cost management, and competitive positioning influence valuation. Startup participation requires long-time horizons and risk tolerance. Diversification strategy requires clarity. Some investors allocate a defined percentage of investable capital to alternative ownership models. A professional may designate 15 to 20% of long-term capital toward fractional real estate and private business equity combined. Remaining capital stays in more liquid structures. Allocation preserves flexibility. Risk assessment requires structured thinking. Does the asset generate current income or rely on appreciation? What economic drivers support demand? How experienced is the management team? What are the total annual fees as a percentage of invested capital? What is the projected holding period? Clear answers reduce uncertainty. Market cycles influence outcomes. During expansion phases, occupancy rates rise and consumer spending grows. During contraction phases, tenant turnover may increase and funding environments tighten. Emotional stability and financial preparation are necessary. Tax reporting complexity also requires attention. Fractional real estate investments may issue annual tax forms reflecting allocated income and expenses. Understanding documentation requirements prevents filing surprises. Technology accelerates access. Regulatory frameworks maintain oversight, offering memoranda outline risks, fees, and strategy. Careful review separates informed participation from reactive decisions. The broader U.S. ownership culture values asset participation. Fractional ownership extends that participation beyond primary residence. Private market access, once concentrated among high-net-worth individuals, has expanded under defined regulatory limits. Participation must align with planning discipline. Unstable income, limited reserves, and high short-term obligations create pressure in long-term lock structures. Stable income, diversified savings, and a long horizon create alignment. Expectations require realism. Fractional ownership does not create rapid wealth. Results depend on asset performance over time. Rental yield growth, operational execution, and market cycles shape outcomes. Platform marketing summaries require verification through data and documentation. Concentration risk must be monitored. Heavy allocation into a single platform increases dependency on that platform's operational integrity. Diversifying across multiple platforms or asset types reduces platform-specific exposure. Operational transparency signals professionalism. Regular updates, detailed financial statements, occupancy metrics, and clear communication indicate disciplined management. Technology dashboards may appear modern. Substance lies in reporting depth. Ownership slices have expanded access. Expansion invites participation. Participation demands discipline. Fractional ownership functions as a tool. Tools require knowledge and patience. Before allocating capital, review your full financial picture. Confirm emergency reserves. Align time horizon. Study offering documents thoroughly. Evaluate management credibility. Access has expanded dramatically in the United States. Structured ownership opportunities are no longer confined to institutions. Individual investors can participate across asset classes once considered unreachable. The rise of fractional ownership reflects technological progress and regulatory adaptation. Its effectiveness depends on informed participation. Opportunity becomes valuable when matched with preparation.